Every financial center in history believed it was different. Venice thought its maritime dominance made it invincible. Amsterdam was certain its innovations in finance had rewritten the rules. London assumed the sun would never set on its banking empire. They were all wrong, and they all failed in exactly the same way. What if I told you that Silicon Valley, the center of global capital allocation, venture funding, and technological finance, is not pioneering a new era of banking, but instead following a 700-year-old script? A script that has 5 distinct stages. A script where stage 5 is systemic collapse. And right now, we are in stage 4. The pattern is deceptively simple. It has repeated itself across centuries, continents, and currencies. It transcends technology. It transcends culture. It is a structural law of financial gravity that no empire, no matter how sophisticated, has ever escaped. Here are the 5 stages. Stage 1. Innovation capture. A geographic center develops a financial innovation so revolutionary that capital flows toward it from across the known world. This innovation grants the center a structural advantage in allocating resources. It becomes the clearinghouse for international trade, debt, or investment. Stage 2. The monopoly illusion. The financial center begins to believe its advantage is permanent. It confuses temporary technological edge with eternal dominance. Competitors emerge, but the center dismisses them as inferior. The elites running the system become convinced they have transcended the old rules. Stage 3. Overreach and leverage. Confidence metastasizes into recklessness. The financial institutions begin lending against future prosperity that hasn't materialized yet. Risk is mispriced systematically. The center starts financing projects with longer time horizons and lower probability of success, but the metrics used internally still show growth. Leverage ratios climb. Stage 4. The credibility crisis. A shock, often external, reveals that the emperor has no clothes. A major institution fails. Trust evaporates. The instruments that the center pioneered, the very innovations that made it dominant, are suddenly revealed as vulnerabilities. Capital begins to flee, first slowly, then all at once. Stage 5. Collapse and displacement. The center implodes. Its financial institutions are either nationalized, liquidated, or absorbed by foreign powers. The global capital that once flowed toward the center redirects to a new geographic hub. The old center never recovers its position. It becomes a historical footnote, studied by future economists as a cautionary tale. This is not theory. This is historical record, and it has played out with mechanical precision 4 times in the last 700 years. Let's examine the first case. In the 14th and 15th centuries, Venice was the Silicon Valley of its age. Its innovation was not software or semiconductors. It was double-entry bookkeeping, maritime insurance contracts, and the world's first true bond market. Venetian banks financed trade routes spanning from London to Constantinople. The city-state became the clearinghouse for European commerce. Capital flowed to Venice for a simple reason. Nowhere else had the financial infrastructure to handle complex, multi-party transactions across vast distances. Venetian ducats were the reserve currency of Mediterranean trade. The Rialto was the Nasdaq of its era. By the late 1400s, Venetian elites believed their position was unassailable. They had survived plagues, wars, and rival city-states. Their banking families, Cornaro, Grimani, Mocenigo, operated with the confidence of permanent aristocracy. They dismissed the emerging Portuguese and Spanish maritime routes as regional nuisances. This was a catastrophic miscalculation. Because confidence breeds recklessness, Venetian banks began financing increasingly speculative ventures. They extended credit to monarchs engaged in endless European wars. They funded merchant expeditions with lower and lower expected returns. The debt instruments they created became more complex, more abstract, more detached from tangible goods. Then came 1499. The Ottoman Empire closed the traditional Eastern trade routes. Venetian banks had financed fleets, warehouses, and trade infrastructure predicated on access to those routes. Overnight, the collateral backing Venetian loans evaporated. In 1500, the Banco della Piazza di Rialto, one of Venice's most prestigious institutions, faced a liquidity crisis. Depositors panicked. The bank couldn't honor withdrawals. The Venetian Senate intervened, but the damage was done. The psychological break had occurred. Portuguese and Spanish ships, exploiting new Atlantic routes, began capturing the trade that Venice had monopolized. Capital fled. By 1530, Venice was no longer the financial center of Europe. By 1550, Venetian banking was a shadow of its former self. The city remained wealthy in art and architecture, but it was economically irrelevant. The center of financial gravity had shifted north to the Netherlands. Venice never recovered. It became a museum. Amsterdam's innovation was the joint stock company. In 1602, the Dutch East India Company issued shares to the public, creating the world's first stock exchange. This was revolutionary. For the first time, risk could be distributed across thousands of investors. Capital could be raised on a scale previously unimaginable. Amsterdam became the epicenter of global finance. The Dutch guilder was the reserve currency. The Amsterdam Wisselbank, the city's central bank, held deposits from monarchs, merchants, and institutions across Europe. Nowhere else had this level of financial sophistication. By the mid-1600s, Amsterdam was untouchable. The Dutch Golden Age wasn't just about art and science. It was about financial engineering. Futures contracts, options trading, margin lending. All of it originated in Amsterdam. The city's bankers believed they had created a perpetual wealth generation machine. They were wrong. Tulip mania in 1637 should have been the warning shot. Speculators used margin debt to buy tulip bulbs at prices 20 times an artisan's annual salary. When the bubble burst, fortunes evaporated overnight. But Amsterdam's banks survived. They learned nothing. By the 1670s, Dutch banks were financing increasingly speculative colonial ventures. They extended loans to the English and French crowns. They underwrote wars that lasted decades. The leverage ratios were staggering. The entire financial system was a tower of debt built on the assumption that Dutch maritime dominance would continue forever. Then came the Fourth Anglo-Dutch War in 1780. Britain's Royal Navy blockaded Dutch ports. Trade collapsed. The loans extended to foreign governments went into default. The Amsterdam Wisselbank, the bedrock of the Dutch financial system, faced insolvency. In 1790, the bank was nationalized. Its gold reserves were found to be a fraction of its reported holdings. The institution had been operating with fraudulent accounting for decades. Confidence shattered. By 1800, Amsterdam was finished as a financial center. Napoleon's armies occupied the city in 1795, but the real conquest had already happened. London, armed with its own innovations in central banking and insurance, had absorbed the capital flows that once went to Amsterdam. The Dutch Golden Age ended not with a war, but with a ledger. Amsterdam's banks simply ran out of credibility. London's innovation was the central bank as we know it today. The Bank of England, founded in 1694, became the model for modern monetary systems. But London's true genius was creating the infrastructure for international bond markets. By the 1800s, London was financing railroads in Argentina, mines in South Africa, and governments across the globe. The British pound sterling was the world's reserve currency. The City of London was the undisputed center of global capital. If you needed to raise money for a large project anywhere on Earth, you went to London. By 1900, London's dominance seemed eternal. The British Empire controlled a quarter of the world's landmass. Sterling bonds were considered as safe as gold. British banks, Barings, Rothschild, Hambros, operated with unshakable confidence. But the seeds of collapse were already planted. London's banks financed World War I with unprecedented debt issuance. Britain borrowed staggering sums from the United States to fund the war effort. By 1918, the UK had transformed from the world's largest creditor nation to one of its largest debtors. The interwar period saw British banks continue extending credit to European governments and colonial enterprises that were economically unsustainable. The entire system was built on the assumption that the empire's wealth would continue flowing to London indefinitely. World War II shattered the illusion. Britain emerged victorious but bankrupt. In 1946, the country negotiated a humiliating $3.75 billion loan from the United States, essentially a bailout. The terms were punitive. Sterling's status as reserve currency was finished. In 1967, the pound was devalued by 14%. Capital flight accelerated. The Bretton Woods system had already shifted the center of gravity to the dollar. By 1976, Britain was forced to seek an IMF loan, a formerly unthinkable humiliation for the world's erstwhile financial superpower. London remains a significant financial center today, but it is no longer the center. That title passed to New York in the 1950s. British banks became subsidiaries of American and European conglomerates. The City of London became a service provider, not a capital allocator. The pound sterling became just another currency. The empire that financed the world couldn't finance itself. Now we arrive at the present. Silicon Valley is the fourth iteration of this cycle, and the pattern is repeating with eerie precision. Silicon Valley's innovation was venture capital and technology startups. The model was revolutionary. Take concentrated bets on high-risk, high-reward companies. Accept that most will fail, but capture exponential returns from the few that succeed. This innovation captured global capital. By the 2000s, if you wanted to build a technology company with worldwide reach, you went to Sand Hill Road. Silicon Valley venture firms, Sequoia, Andreessen Horowitz, Kleiner Perkins, became the gatekeepers of innovation. The dollars flowing into the region were staggering. But the real innovation was financialization of technology. Silicon Valley didn't just fund companies. It created an entire ecosystem of financial instruments: convertible notes, safes, liquidation preferences, secondary markets for private shares. It turned equity into a tradable commodity years before companies went public. By 2010, Silicon Valley believed it had transcended the old rules. The narrative was explicit. Software was eating the world, technology companies had different economics than traditional businesses, and the old metrics didn't apply. Blitz scaling became the mantra. Growth at all costs. Profitability was for dinosaurs. The goal was market dominance funded by endless capital. The assumption was that low interest rates and abundant liquidity would continue forever. Venture capital firms raised larger and larger funds. In 2000, a $500 million fund was enormous. By 2020, billion-dollar funds were common. SoftBank's $100 billion Vision Fund seemed like the future. Silicon Valley dismissed traditional financial centers, New York, London, Tokyo, as relics of a pre-digital age. This was hubris. The Federal Reserve's response to the 2008 financial crisis created a decade of near-zero interest rates. This was jet fuel for Silicon Valley. Capital became free. Risk became unpriced. Venture firms began funding companies with no clear path to profitability. Startups burning $100 million per year were raising $500 million rounds at billion-dollar valuations. The metrics used to justify these valuations became increasingly abstract: total addressable market, network effects, engagement metrics. The entire ecosystem became a Ponzi-like structure. Early investors needed new investors at higher valuations to generate returns. Companies delayed profitability indefinitely because capital was abundant. The system only worked if the music kept playing. Then came the banks. Silicon Valley Bank, the financial backbone of the tech ecosystem, grew from $40 billion in assets in 2016 to $212 billion by 2021. This was growth fueled by deposit inflows from venture-backed startups. The bank took those deposits and invested heavily in long-term government bonds. This was the overreach. SVB was making a leveraged bet that interest rates would stay low forever. So was the entire ecosystem. In March 2022, the Federal Reserve began raising interest rates to combat inflation. This was the external shock. Suddenly, the math changed. Technology stocks, priced for zero interest rates, collapsed. The Nasdaq fell 33% in 2022. Venture funding dried up. Startups that had never needed to worry about profitability suddenly faced existential cash flow crises. Then came March 2023. Silicon Valley Bank failed in 48 hours. The bank's bond portfolio, purchased when rates were near zero, was now worth billions less than its face value. When depositors began withdrawing funds, SVB had to sell bonds at a loss. The losses triggered panic. The classic bank run dynamic. The FDIC seized SVB on March 10, 2023. It was the second largest bank failure in U.S. history. 2 days later, Signature Bank collapsed. First Republic followed in May. 3 major banks, all deeply integrated into the technology financing ecosystem, gone in 2 months. This was the credibility crisis. The instruments that Silicon Valley had pioneered, the growth at all costs model, the extended cash burn, the valuation metrics detached from profitability, were revealed as catastrophically vulnerable to rising interest rates. But here's what matters. The crisis didn't destroy Silicon Valley. Not yet. It revealed the vulnerability. Stage 4 is not the collapse. Stage 4 is the moment the myth breaks. And we are living in that moment now. Since the 2023 banking crisis, capital flows into venture capital have cratered. In 2021, U.S. venture firms raised $131 billion. In 2023, that number fell to $67 billion, a 49% collapse in 2 years. Startup valuations have crashed. Companies that raised at $1 billion valuations in 2021 are now raising down rounds at $300 million. The IPO market is frozen. Companies that were supposed to go public in 2022 to 2023 remain private, trapped. The secondary markets for startup shares, platforms like EquityZen and Forge, show discounts of 40 to 60% to last funding round valuations. This is a fire sale in slow motion. Meanwhile, the leverage in the system is being exposed. WeWork, once valued at $47 billion, filed for bankruptcy in 2023. FTX, the cryptocurrency exchange deeply embedded in Silicon Valley networks, collapsed in 2022 with $8 billion in customer funds missing. Theranos, valued at $9 billion in 2014, was revealed as a fraud. These are not isolated failures. They are symptoms of systemic mispricing. The venture capital model itself is under stress. The traditional VC fund structure assumes that exits, either through IPOs or acquisitions, will happen within 7 to 10 years. But the companies funded in the 2010 to 2020 period are not exiting. They are trapped in a liquidity desert. Many will never return capital to their investors. This means the entire multi-decade track record that made Silicon Valley dominant is eroding in real time. So where does this lead? History provides the answer. Let's be clear about what Stage 5 means. It does not mean technology stops. It does not mean innovation ends. It means Silicon Valley loses its structural monopoly on capital allocation for technology. Here is what Stage 5 looks like, based on historical precedent. Right now, the flight is beginning. Sovereign wealth funds and pension funds, the largest institutional investors, are reducing their venture allocations. In 2024, CalPERS, California's public pension fund, announced a 30% reduction in its venture capital portfolio. This is a signal. International capital, which flooded into Silicon Valley during the 2010s, is now looking elsewhere. China's technology sector, despite regulatory crackdowns, has developed independent venture ecosystems in Shenzhen and Beijing. Europe is building its own venture infrastructure. The Gulf states are creating sovereign venture funds that bypass Silicon Valley entirely. The assumption that all technology capital must flow through Sand Hill Road is breaking. SVB was the warning, but it was not the last. Several smaller banks that serve the technology sector remain fragile. They hold portfolios structured for a zero-interest rate world that no longer exists. More significant is the coming wave of venture fund failures. Many funds raised in 2017 to 2020 will fail to return capital. Their institutional investors, university endowments, pension funds, foundations, will reduce future allocations. The death spiral begins when the money providers stop providing money. We are watching the credibility of the venture capital model itself erode. The industry built its reputation on a decades-long track record. That track record is being rewritten as failures mount. Every time a financial center collapses, the capital flows to a new geographic hub. When Venice fell, Amsterdam rose. When Amsterdam fell, London rose. When London fell, New York rose. Where will the capital go when Silicon Valley's monopoly breaks? The most likely candidates are Austin and Miami, already capturing U.S. capital flight from California. Lower taxes, cheaper real estate, and aggressive business-friendly policies. These cities are building their own venture ecosystems. They will not replace Silicon Valley entirely, but they will fragment its dominance. China's technology corridor, Shenzhen-Beijing-Hangzhou. Despite regulatory uncertainty, Chinese technology companies are now developing innovations in AI, electric vehicles, advanced manufacturing, independent of Western capital. The assumption that breakthrough technology must originate in Silicon Valley is already false. The Gulf states, Saudi Arabia and the UAE are deploying sovereign wealth funds to build domestic technology hubs. They are hiring Silicon Valley talent, copying Silicon Valley models, but keeping the capital in the Gulf. This is a direct challenge to the old center. A distributed model. The rise of remote work and digital infrastructure means that technology capital allocation may not require a geographic center at all. Startups can now raise funding from investors scattered across continents. The centralization that made Silicon Valley necessary may be obsolete. The pattern suggests that no single center will replace Silicon Valley. Instead, we may see a multipolar world of technology finance, a fragmentation that mirrors what happened after London's collapse. But the most important parallel to history is psychological. Venice didn't collapse because its ships stopped sailing. It collapsed because the world stopped believing that Venice was special. Amsterdam didn't collapse because its banks ran out of money. It collapsed because the world stopped believing that Amsterdam's financial innovations were superior. London didn't collapse because Britain lost World War II. It collapsed because the world stopped believing that the pound sterling was the safest store of value. Right now, Silicon Valley is entering its psychological break. The narrative that this is the only place where transformative innovation happens is crumbling. The mystique is fading. The myth of inevitability is dying. And once that psychological break occurs, the capital flight becomes self-reinforcing. The best entrepreneurs stop moving to Silicon Valley. The best investors stop concentrating their bets there. The network effects that made the region dominant begin to work in reverse. This is stage 5, and it is beginning now. How long will this take? History suggests 10 to 20 years from the credibility crisis to complete displacement. Venice's decline took roughly 30 years from the 1499 Ottoman closure of trade routes to its irrelevance by 1530. Amsterdam's collapse took about 20 years from the beginning of the Fourth Anglo-Dutch War in 1780 to the Wisselbank's nationalization and loss of capital flows by 1800. London's displacement took approximately 30 years from the end of World War II in 1945 to the IMF bailout in 1976. Silicon Valley's credibility crisis began in 2022. If the pattern holds, by 2040 to 2050, Silicon Valley will no longer be the uncontested center of technology finance. It will still exist. It will still be wealthy. But it will be just one of many centers, not the center. And that is functionally the same as collapse for a region whose entire identity is built on dominance. This analysis is not a prediction. It is a pattern recognition exercise. The 5-stage cycle has repeated 4 times across 700 years. It transcends specific technologies, political systems, and economic ideologies. It is a structural inevitability of financial centers that confuse temporary advantage with permanent dominance. Silicon Valley is not immune. The belief that this time is different is precisely what Venice believed, what Amsterdam believed, what London believed. They were all wrong. The signs are already visible. The banking crisis of 2023 was the inflection point. The capital flows are shifting. The alternative centers are rising. The narrative is breaking. For investors, entrepreneurs, and anyone whose livelihood is tied to the Silicon Valley ecosystem, this matters. The system that has governed technology finance for 30 years is entering its terminal phase. This does not mean opportunity disappears. Every collapse creates new winners. Amsterdam's collapse made London. London's collapse made New York. Silicon Valley's decline will create new centers, new models, new opportunities. But those opportunities will not be in the old system. They will be in whatever comes next. The pattern is clear. The cycle is inevitable. And we are at stage 4. For those willing to look.